Hey traders, Mike Sir here. Welcome back to my channel. I'm constantly on the lookout for trader success stories to profile who are not hedge fund managers or traders who have a financial or business background. I'm actually looking for everyday independent traders who trade their own money and have made millions from it. Now this way you can believe that the little guy or girl can actually make it on Wall Street. Now just like in my last trader profile video where I profiled an everyday regular guy who turned $20,000 of his own money into over $42 million in the stock market. But in this video, I'm going to share an even better story. I'm going to profile a guy who started with $2,500 and turned it into $50 million. Besides the impressive $50 million in profits that he has generated in his 17-year trading career, the other amazing stat is he has compounded his account at an average rate of 80% per year, an incredible consistent track record. So in this video, I'm going to share his trading strategy with you and teach you how you can achieve his incredible trading success as well. The trader I'm referring to is Jeffrey Neumann. He has kept a very low profile of himself over the years, so I haven't been able to gather any pictures or videos of him. But I'm sure you will enjoy and learn lots from his story, so let's get started. Before Jeffrey started trading, he had no prior knowledge of the stock market, let alone any business background at all. He just graduated from college and had no intention to pursue his initial goal of going to med school. In fact, he was drawn to trading penny stocks because they were cheap and moved by a large percentage each day. So when he received a $2,500 check from his car insurance company for damages to his car during a hailstorm, he used that money to open his first trading account. Now he had immediate trading success when he started out making hundreds of dollars a day, and before he knew it, he was making thousands of dollars a day. Then a little over a year after he started trading, he made over $1 million. He couldn't believe that at 23 years old, he was a millionaire. The biggest surprise for many people who hear this story was that Jeffrey didn't even understand how the stock market really worked at that time. He was only utilizing one trading system that had nothing to do with the company's fundamentals or involved any chart reading. You see, what Jeffrey was doing was arbitrage trading. Now, Jeffrey's broker at the time allowed traders to put in orders 2 decimal places beyond the penny decimal, whereas most brokers at the time only went out to a penny. For example, Jeffrey's broker allowed him to enter in an order for, let's just say, 2.01 cents versus most brokers who would only accept 2 cents and no decimal places past the penny cent mark. Now this created a potentially profitable arbitrage situation for Jeffrey, and he milked this advantage. So what Jeffrey did was, if a stock was trading between 2 and 3 cents, meaning that there were buyers at 2 cents and sellers at 3 cents, he would put in a bid order at 2.01 cents, and if his order was filled, he immediately placed his order to sell at 2.99 cents. So if anyone wanted to buy the stock at 3 cents, Jeffrey's sell order would get filled first ahead of all the 3-cent sellers. He would make 0.98 cents on every share that he traded, and he would just keep doing that all day. Jeffrey calculated that he was making about 13% after commission on every trade that he made. In addition, if there were any large sell orders hitting below his entry price, let's just say at 2 cents, he was able to get out with a small loss of only 0.01 cents versus a potential profit of 0.98 cents, an extremely profitable arbitrage trading system. But this system started to lose its edge when other people began to catch on and do the same thing. He had to repeatedly raise his bid prices and lower his ask prices to levels where he would get filled. His arbitrage trading system ended about a year after he started, when the bid-ask spread was so tight that there was no opportunity for him to make a decent return. He had to learn how to trade, and this is when he discovered technical analysis. On a daily basis, Jeffrey looks at a lot of charts and focuses on charts that have a steady downtrend. Then he wants to identify the stocks in these charts who had large block size orders, meaning that there was accumulation of these stocks by larger buyers, perhaps institutions or company insiders. Essentially, he wanted to follow what the big money was doing, and if they were buying, he would buy as well. However, his key core strategy revolves around trading in specific sectors with key catalyst drivers. Before then, he was trading in random stocks without any idea why he was buying the stock other than the charts. Now, if Jeffrey likes the potential of a specific sector, he would buy a whole bunch of stocks related to that sector at the same time. He would first of all start buying smaller positions as he would do his own due diligence, and once he had a strong conviction on the trades, he would start adding to his positions by hundreds or even thousands of times. For example, he might start off with $1,000 in a stock, but once he's convinced of the enormous potential of the sector and the related companies in that sector, he would bet millions on it. Now, it's not rare to see Jeffrey have more than 1/3 of his entire account in one stock or sector. It's this go big mentality that has led to some big and huge successes for Jeffrey. Before I share with you the 5 stock buying rules that has made Jeffrey an extremely successful trader, please smash that like button and hit subscribe if you haven't already. Okay, Jeffrey's rule number 1 is to look for stocks that have fallen sharply. Jeffrey likes to buy beaten down stocks that are unloved by the market. Specifically, he looks for stocks that have seen a large price decline or have been in an extended sideways movement near its all-time lows. Then he would patiently wait for these stocks to show some form of recovery by seeing other traders start to show interest in the stock, and then he would start buying. For example, if he saw that there was 100,000 shares for sale at 25 cents, he would be the guy that was buying the last 10,000 shares at that price. He wanted to make sure that there was buying interest for a beaten down stock before he got in. In addition, he likes to see the stock price break out of its downtrend line, and that would also be a signal for him to get into a stock. Jeffrey's rule number 2 is to become an expert in the sector that you are trading in. One of the criteria that Jeffrey has before putting money into a company's stock is if the company makes a consumer product, he would buy the company's product and see if he likes it. If he doesn't like the product, then he won't trade the stock. For example, a few years ago, Jeffrey discovered the potential of the 3D printing space and thought it might be an emerging opportunity. Now, as part of his research, he spent $10,000 on buying 4 different 3D printers and taught himself how to utilize these printers. He wanted to know which company made the best 3D printers and why. He immersed himself in the industry by attending industry conferences, trade shows, quarterly shareholder calls, and even meeting with the company management. While becoming a 3D printing expert, he discovered a bioprinting company called Organovo, which he thought had a lot of potential. Now, he visited the CEO, and upon seeing their bioprinter in action, he immediately went home and bought the stock. However, the stock crashed 30% when they did a concurrent share filing raise to list on the New York Stock Exchange. But from Jeffrey's perspective, the outlisting provided the ultimate buying opportunity for him to buy more of the stock, and he went all in. At his peak, he owned 3 to 4% of the company. Now, at that time, Organovo stock price was actually at $3.50, and within a year, it went to $12, which is where he liquidated most of his positions. He made $10 million on that one trade alone. Jeffrey's rule number 3 is to look for catalysts. Jeffrey is always on the lookout for catalysts that could drive a stock's price higher. So in 2009, he knows of one penny stock called Sponge Tech that traded almost 200 million shares in one day. He found out that insiders of the company had recently bought 750 million shares, which amounted to half of all the outstanding shares at a 7/10 of 1 cent. This intrigued him because if company insiders were buying massively, it signaled a strong confidence in the company. Now, Jeffrey ended up buying 6 to 7 million shares of the stock between 1 to 2 cents. The company was very aggressive in its advertising campaigns, and due to its publicity, the stock price kept going up, and Jeffrey would sell 100,000 shares every time that it went up 1 cent. By the time the stock reached 25 cents, Jeffrey still had 3 million shares left and realized that the company was extremely overvalued at that price. So he started selling. he would end up making $700,000 on that trade alone. Now, whether it was pure luck or good timing, after he sold, the price collapsed to 5 cents, and it actually turned out that the company and its executives were engaged in a massive pump and dump scheme and were later charged by the SEC. Jeffrey's rule number 4 is to wait for bottoms. During the financial crisis in the fall of 2008, financial stocks like Citigroup saw their stock prices drop more than 90% from its highs. Now, Jeffrey tried many times to pick the bottom on these stocks, but he kept getting stopped out. Then one day he saw financial stocks were breaking through their steep downtrend lines on high volume, and this was the trigger for him to load up on a basket of these stocks and a ton of 2-week out option contracts just 10 minutes before the market closed. Now, after the stock market closed, he found out that the US government was going to purchase $700 billion worth of illiquid assets as part of the Troubled Asset Relief Program. Because of this positive news, the next morning, all the stocks that he had bought were up as much as 50% from where he had bought them. Within 5 minutes of the market open, he took profits on all of his positions that he had bought the previous day. So literally just in 15 minutes of trading, he made nearly $900,000. Jeffrey's last rule is to look for happy customers. As mentioned earlier, Jeffrey would try a company's product before investing into the company's stock. But in this case, he bought a cannabis stock after hearing an enthusiastic product endorsement from a happy customer. Now, about 2 months before CBD, which is part of the cannabis and hemp industry, became legal at the US federal level, Jeffrey went into a local liquor store and the owner kept telling him how this CBD water beverage literally changed his life. Now, Jeffrey looked into the maker of the beverage and found that it was a 2-cent stock that was about to break above its 2-year downtrend line. And this was a key buying signal, and he immediately started accumulating shares in the company to as much as 3 to 4 million shares. A few weeks after buying the stock, the price started rising sharply and went up as much as 1,000% to 25 cents. However, upon learning from the liquor store owner that there was potentially something wrong with the beverage, he immediately sold all his shares right at the top. Jeffrey has been unbelievably lucky with penny stocks, often buying them for pennies and selling them at their peak for 10 times or even 20 times return. Oftentimes after he sells, the stock price plunges in value, so how does he know when to sell? Now, his philosophy is if the stock that he's holding is not continually moving up or starts going down sharply, then he will exit his position. In addition, he would take a look at the stock's liquidity to see if it's declining and, more importantly, if the buyers are drying up. This will tell him that demand is starting to decrease for the stock, and at some point the sellers will come out to push the stock down. Now, generally, he has a good idea on how the stock price performs as he monitors it daily, and if the stock starts acting differently, he starts reducing his positions. Thanks for watching. If you like this video about Jeffrey Neumann, you can click on the left to watch other videos where I profile the top traders in the world, or click on the right to watch the full playlist. I'll see you guys in the next video.